What's up, you guys? Welcome back to the Average Joe Investor channel. In today's video, I want to talk a little bit with you about the difference between selling cash secured puts and selling covered calls. Why would you choose one over the other? Are there any benefits to one over the other? In this video, I'll break down for you exactly what a cash secured put is compared to a covered call. Then we'll talk about the 3 reasons why you would utilize cash secured puts in your portfolio and the 2 big reasons why you would use covered calls. First off, let's talk about what a covered call is and what a cash secured put is. Starting with covered calls. In order for you to sell a covered call, you have to already own shares of the underlying stock or ETF. Could be any investment, doesn't matter, but you have to own the shares first. And then what you're doing is selling an option, and what that option is doing, in this example, if we're looking at the S&P 500 or SPY, if the current market price is 506.45 right here, and we are selling a covered call at 511, what we are doing is creating a cap or an obligation to sell our shares if the market price of SPY goes up to and beyond the 511 strike price in this scenario. If that happens, we have to sell our shares at expiration at $511 per share times how many shares we own, 100 shares in this situation. But we still get to keep the option premium we received when we sold the covered call. But the covered call is going to cap us on how much capital appreciation we get to receive if we have to sell our shares. The covered call creates that obligation. So in this situation here, if the market price starts here at 506.45 and it does anything like this, let's say it goes over here, ends here, or maybe it ends down here, or even up here, even if it goes like this, but then it ends down below the strike price. In all of these scenarios, at expiration, your covered call contract is going to expire worthless. That obligation to sell your shares is going to go away, and you get to keep all of that option premium. If the market goes above and stays above, let's say right up here at 512, let's say, in that situation, we'll have to sell our shares not for 512, but for 511, because that's the strike price. So that difference between the ending price of 512 versus our strike price 511, that's not a loss, but it is opportunity cost. We don't get to participate in all of the capital appreciation of the underlying stock, but we do get to keep the option premium we received when we sold the covered call. Now let's consider a cash secured put. In this situation, you don't own the shares. Instead, you're holding cash. And the obligation is a little bit different here. Instead of having an obligation to sell our shares if a certain price is reached, we're doing the opposite. We are creating an obligation to buy 100 shares if the price of the stock or the ETF drops to a specific price, the strike price, by expiration. So in this situation, if the red line is the current market price for a cash secured put, and this is the cash secured put strike price we sell, if the market does anything along here, does this right here, or maybe it ends here, ends even higher than our current strike price, any of these situations at expiration, our cash secured put is going to expire worthless. Okay, that obligation to potentially buy 100 shares at the strike price goes away. We get to keep all of our option premium. However, if the market does, and this also includes if it does this, but ends back up here. But if the market does end up at expiration below our strike price, then in that situation, if we get assigned, we will have to then buy 100 shares at whatever that strike price is, and we'll now own the investment, but we still get to keep that option premium we received when we sold the cash secured put. So the big key difference here between cash secured puts and covered calls is the ownership of the underlying asset. With covered calls, you are owning shares of the stock or the ETF, whatever it is. With the cash secured put, you own cash. You don't own the index, the ETF, or the stock. So now that we have a fundamental understanding of what the key differences are between cash secured puts and covered calls, why might you choose a cash secured put as opposed to a covered call? In my mind, there are 3 big reasons why you would choose a cash secured put. Number 1, you like holding cash right now. And there's certainly a case to be made right now with the markets at all-time highs. You might be thinking, well, the markets might drop soon. I'd like to be holding cash so that I'm more set up to take advantage of lower prices in the future if the markets go down. Second big reason here is since you don't own the shares of the index or the ETF, the stock, you're not going to immediately participate in any losses in the price per share of the stock because you own cash. not the actual stock or ETF. So you avoid the potential erosion of your capital value. The third big reason why you might want to use cash secured puts is you do want to own the stock, but you just don't want to own the stock at the current market price. Let's say the current price is $50 per share, but you really want to own it at $48 per share. Well, then you don't have to sit there and just wait for the price to drop. You can actually sell cash secured puts at whatever price you want to buy the stock. And that way, if the market eventually comes to you, you've been collecting option premium this whole time, and then you get to buy the stock for less than what it was previously trading for. So those are the big reasons for selling cash secured puts. And then the fourth one actually could be there as well, the fact that you can potentially double dip and hold cash and collect interest on that cash and potentially sell cash secured puts and get double the amount of income. Not every brokerage allows you to do that. I know Fidelity does. Some do not. So just be aware of that. Be mindful that you might not be able to collect double income there. The real big reason why you would choose to sell covered calls is because you want to be able to participate in the capital appreciation of the stock or ETF if it does occur. As a reminder, once you own the shares, we don't know what the future holds, what the market's going to do in the next 30 days, 60 days, 120 days, or in the next year. The market could go up a lot or a little. The market could go down a lot or a little. And by owning the shares, you are participating in any change in value of the underlying stock or ETF. This would make a lot of sense if you're investing long-term for retirement and you're holding the S&P 500 or the NASDAQ 100 and you want to sell covered calls along the way, but you also want to be able to participate in the capital appreciation over time that we come to expect. If you want to learn more about selling options, cash secured puts, covered calls, etc., you can certainly join the Average Joe Investor Patreon community and the Discord chat. Tons of great investors in there who are already running these strategies. You can learn from them, learn from me, tons of value there. Or if you want to work one-on-one with me, you want to ask your own questions, you want to be able to work through different strategies, things like that, you can certainly join the exclusive access or the VIP tiers of the Patreon community as well. We've got many investors already doing that and they're getting a ton of value out of that. If you want to learn more, check out the link down in the description below. Hopefully you found some value out of this video, guys. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.